Good day, ladies and gentlemen. We are from Group 8H. Today, we are going to present Topic 3. It is about audit risk, materiality, and sampling. So everyone, what is audit risk? Audit risk is a risk that an auditor will conclude financial statements are fairly stated and unmodified report is issued, when in fact they are materially misstated. For example, the auditors do not uncover a material misstatement due to well-concealed frauds. Therefore, a simple definition of audit risk is when auditor express an inappropriate audit opinion and the financial statements contain material misstatement. Next, we proceed with the definition of audit acceptable risk. AAR is a measure of how willing the auditor is to accept that the financial statement may be materially misstated after the audit is completed and an unqualified opinion had been issued. It has an inverse relationship with evidence. AAR decrease, evidence will increase. Now, what is materiality? Information is said to be material when the misstatements could influence the economic decision of users, taken on the basis of the financial statement. Materiality is an auditor's preliminary estimates of the smallest amount of misstatement that could be material to the client financial statement. Materiality's concept is, it is the criteria used by accountants and auditors in distinguishing between important and unimportant matters. Auditor is responsible to determine that the financial statements prepared by the management are free from material misstatement. There are three guidelines in determining materiality, which are quantitative guidelines, qualitative guidelines, and professional judgment guidelines. In quantitative guideline, bases are needed for evaluating materiality. Because the materiality is relative, therefore, it is necessary to have bases for establishing whether misstatements are material. The materiality threshold also can be expressed in terms of percentage on bases selected rather than an absolute amount. Next, qualitative factors also affect materiality. Certain types of misstatements are also important even if the dollar amounts are small. For example, amount involving fraud considered more important than error, because frauds will reflect honesty and reliability of the personnel involved. Next, misstatements that are immaterial but still need to disclose to comply disclosure requirement is also the example of qualitative factor. Other than that, small amount of misstatement could be material if bad consequences arise from contractual obligations. For example, in granting loan to the company, the bank, for example, required the company to maintain sufficient net working capital. So, if the net working capital were less than the required minimum, even though in a small amount, any misstatement could be material because this may put the loan in default. Fourth, misstatements that are immaterial may be material if it affects a trend in earning. For example, for the past 5 years, earning increased 5% per annum, but income for this year declined by 1%. Any misstatement may be material to maintain the trend. Now, the third guideline is by professional judgment. There is no specific rules or standard is provided in determining materiality. It requires considerable professional judgment by practitioners. For example, a policy statement of a firm. The combined total of misstatement in the financial statements exceeding 10% is normally considered material. A combined total less than 5% is presumed to be immaterial in the absence of qualitative factors. combined misstatement between 5% and 10% requires the greatest amount of professional judgment to determine their materiality.
Next, we proceed to audit model. Audit risk mode provides the foundation for auditor-performed procedure to access the risk of material misstatement and design further procedure to respond to the risk. There are three types of audit risk model, which are inherent risk, control risk, and detection risk. Let us look at inherent risk. This risk relating to the characteristic of the business. It defined as the possibility of incorrect or misleading information in financial statements resulting from something other than failure of controls. If there are high likelihood of misstatement, ignoring internal controls, the auditor might conclude that the inherent risk is high. There are several factors should be considered when assessing inherent risk. There are nature of the client's business, results of precious audits, initial versus repeat engagement, related parties, non-routine transaction, judgment required to correctly record account balance and transaction, and makeup of the population. Now, we move to control risk. This risk is caused by the failure of existing controls or the absence of controls, leading to incorrect financial statements. The internal control is effective if control risk decrease. Under ISA 400.5, a material misstatement could occur and not be prevented or detected and not corrected on a timely basis by the entity's internal control structure. Control risk can be divided into two levels. First, general level. Second, specific level. Under general level, auditors should consider attitude of management towards the important control system by looking at whether the company has established budgetary system, internal audit department, risk management department and audit committee. Furthermore, under specific level, auditors should also consider and evaluate whether existing control procedures is good enough to prevent and detect errors or not. However, internal control systems cannot provide management with conclusive assurance because inherent limitations such as cost-benefit analysis. This is because sometimes cost to set up internal control is too high. Human error due to the carelessness, ignorance and rejection to adhere to the system, misunderstandings of instructions. Internal control become not relevant due to changes in conditions and environment. Lastly, detection risk. Detection risk is caused by the failure of the auditor to discover a material misstatement in the financial statements. This is the only risk which can be directly controlled by the auditor and depend upon his assessment of inherent risk and control risk. Detection risk will be higher if the auditors are not competent and do care, whereas detection risk will be lower if the auditors are competent and exercise due care. The auditor has to decide on the nature, extent, timing, and cost of the audit in the determination of the level of detection risk. The audit procedures is to carry out our substantive test and analytical review procedures. The auditor's responsibility to design audit procedures that will provide reasonable assurance that any material misstatement will be detected and removed from the financial statements.
Next, how does materiality and audit risk related? There is an inverse relationship between materiality and audit risk. The lower the materiality level, the higher the audit risk. For example, reducing the materiality amount from 1 million ringgit to 100,000 ringgit and gather the same audit evidence. Morally, audit risk will increase.
Let's moving on to analytical procedures. First thing first, what is analytical procedures? Analytical procedures are financial audit processes which help an auditor understand the client's business and changes in the business, and to identify potential risk areas to plan other audit procedures. Next, nature of analytical procedures. Analytical procedure comprises are two consideration. First, analytical procedures include the consideration of comparisons of the entity's financial information. For example, comparable information for prior periods, which is historical data. Next, anticipated results of the entity, such as budgets and forecasts. Similar industry information, such as a comparison of the entity's ratio of sales to debtors with industry averages. Second, analytical procedures also include consideration of relationships. Typically, relationships are considered between elements of financial information that would be expected to conform to a predictable. Furthermore, it also considers between financial and non-financial information such as payroll costs to number of employees. Analytical procedures are used for the purposes which are preliminary analytical review, which is to assist the auditors in planning the nature, timing and extent of other audit procedures. Then, used for substantive procedures, when their use can be effective or efficient than tests of information in reducing detection risk for detailed financial statement assertions. Last but not least, as in whole review of the financial statements in the final review stage of the audit. What factors are influencing when determining materiality? The factors are the size of the organization's revenues and expenses and company's industry. Application of audit's risk model to audit work. ABC is an audit firm which has accepted the audit of XYZ. During the planning of the audit, manager has noticed the following information. XYZ is a listed company operating in the financial services sector. XYZ has a large network of subsidiaries, associates and foreign branches. The company does not have an internal audit department, and its audit committee does not include any members with a background in finance. It is the firm's policy to keep the overall audit risk below 10%. Inherent risk in the audit of XYZ's financial statements is particularly high because the entity is operating in a highly regularized sector and could be misrepresented in the financial statements in the absence of relevant financial controls. The first audit assignment is also inherently risky as the firm has relatively less understanding of the entity and its environment. Besides, the company does not have proper oversight by a competent audit committee of financial aspects of the organization. The company also lacks an internal audit department, which is a key control especially in a highly regulated environment. Therefore, control risk involved in the audit also considered as high.
Audit sampling. In ISA 500, audit evidence is the auditor should obtain sufficient appropriate audit evidence to be able to draw reasonable conclusions on which to base the audit opinion. Audit sampling involves an audit procedures which enables auditor to obtain and evaluate audit evidence. Here are the differences in sampling and non-sampling risk.
Two types of audit sampling are statistical sampling and non-statistical sampling. Characteristics of statistical sampling are: random selection of sample, Use probability theory. Allow auditor to rely on smaller sample. And as defend measure at the court.
Meanwhile, non-statistical sampling does not have characteristic as statistical. Auditor may use non-random selection method and use his professional judgment to select and evaluate and also do conclusion. Auditor will select sample item that believed to provide useful information. 3 categories of statistical sampling are attribute sampling, monetary unit sampling and classical variable sampling. Attribute sampling used to estimate proportion of population that have specified characteristics. Classical variable sampling use normal distribution theory to evaluate characteristic of population. Monetary unit sampling use attribute sampling theory and techniques to estimate the amount of misstatement.
When to use statistical sampling. The decision to use sampling method depend on auditor judgment to obtain sufficient audit evidence. The advantages of statistical sampling are: design an efficient sample, measure the sufficiency of evidence, allow auditor to rely on smaller sample, plan audit approach, quantify sampling risk. The disadvantages are: training auditor in use of sampling technique, design and conduct sampling application. Why auditor use non-statistical sampling? The auditor consider the audit evidence and information obtained. It is less costly and less time-consuming techniques.
These are advantages and disadvantages of non-statistical sampling.
The differences of statistical and non-statistical sampling stated as below.